Welcome back. Today, we have a genuinely fascinating breakdown queued up for you. We're going to unpack the Q1 2026 financial data and really dig into the intense valuation debates surrounding a highly unique, super fast-growing real estate stock. I'm talking about Curbline Properties, trading under the ticker symbol CURB. Now, whether you're actively tracking the REIT sector or you're just looking for a real-world masterclass on how a company balances aggressive expansion with Wall Street's sky-high expectations, this explainer is going to give you the exact structure you need to understand the story playing out right now.
Because here's the core tension we're exploring today. On one hand, you have a business demonstrating absolutely stellar growth and execution. I mean, they are crushing it. But on the other hand, it boasts a massive valuation premium that honestly has a lot of value investors raising their eyebrows. So the question isn't just whether this is a good company, it's whether the stock is priced so highly that it demands absolute, flawless perfection going forward. Okay, let's dive right into this and set the stage. If you aren't familiar with Curbline Properties, they hold a really distinct title. They're actually the market's first and currently the only publicly traded real estate investment trust, or REIT, that is exclusively targeting convenience shopping centers. Right? They aren't building massive enclosed malls or sprawling grocery-anchored plazas. No, they've carved out a highly specific territory, and they are moving incredibly fast to own the whole thing.
Let's start with Section 1, Meet Curbline Properties. So before we look at their Q1 report card, we really need to understand the underlying asset. What exactly is a convenience property, and why is this such an insanely lucrative niche? Well, a true convenience property sits right on the literal curb line of well-trafficked intersections and major vehicular corridors. Think of that place you frantically pull into for a $7 coffee or a quick ATM run on your way to work? That's them. They feature standardized unit sizes, which makes them super attractive to national, high-credit tenants. We're talking quick-service restaurants, wellness operators, financial services. But here is the absolute most critical part of their strategy. Curbline specifically targets suburban areas with really high household incomes. The communities they operate in have a median household income of over $122,000. Now, compare that to the national median of roughly $83,000, and you can instantly see why retailers desperately want these spots. And since there are over 68,000 of these centers nationwide, mostly owned by private, mom-and-pop investors, it's a massive, highly fragmented market that is just absolutely ripe for consolidation.
Moving right along to Section 2, the Q1 2026 financial snapshot.
Let's shift our focus to the hard numbers and see how this Curbline strategy translates to the bottom line. Now, if you just glanced at the headline net income on this slide, you might actually be a bit concerned. You'll see net income drop sharply from $10.6 million in Q1 of last year down to just $3.6 million this quarter. At first glance, that looks like a massive step backward, right? But hold on, look at operating FFO, or funds from operations. That actually went up from $25.1 million to $29.9 million. So how on earth can net income plummet while FFO rises? Well, it all comes down to the super aggressive pace of their acquisitions. That aggressive buying brings rising interest and heavy real estate depreciation expenses, which artificially drags down standard net income. Now, what's really interesting about this slide is how it totally demystifies real estate accounting for us. You see, for a REIT, traditional net income is rarely the best metric because real estate technically depreciates on a balance sheet over time, even if the actual physical property is gaining value in the real world. Operating FFO strips out those non-cash accounting items. It's a purely cash-based measure showing the recurring cash generated by their core property operations. Think of it like a household budget that separates your steady monthly income from big, one-time expenses. If you want to judge the true operational health and the dividend sustainability of a REIT, FFO is the absolute most important number you need to be watching. And when we use the right metrics to assess their property-level operations, the growth is frankly explosive. Total net operating income, or NOI, surged a massive 50.7% year over year to hit $42.9 million. This is a staggering leap. But to be fair, it's vital to understand that this massive jump wasn't primarily from jacking up rents on their existing tenants. No, it was driven heavily by a very aggressive spree of new asset acquisitions. Which brings us nicely to Section 3, aggressive acquisition growth. So how exactly is Curbline achieving this incredible scale-up? Well, they aren't just buying a property here and there. They are actively and aggressively consolidating the market. Look at these numbers.
In Q1 alone, they acquired 14 convenience centers for $142.4 million, and they did not slow down. They kept their foot firmly on the gas in April, scooping up another 8 centers for almost $94 million. In fact, things are going so well that they just raised their full-year investment target to approximately $850 million. And they absolutely have the war chest to pull it off. They're sitting on nearly $306 million in cash as of March 31st, not to mention a vast amount of unsettled forward equity. But wait, how do they afford all this without taking on a ruinous amount of debt? They use something called an ATM program, or an at-the-market equity program. Essentially, this lets them sell newly issued shares directly into the open market at the current trading price, exactly when they need the capital. It provides highly flexible, on-demand access to cash. It's almost like having a credit line, but using your own stock instead of bank debt. It's a fantastic tool for fueling a massive acquisition spree like this, though it is important to remember that it does inherently increase the number of shares outstanding, which of course carries the risk of shareholder dilution. Just to give you an example of this capital generation engine at work, $61 million. That is the expected gross proceeds from 2.6 million forward shares sold under their ATM program during Q1 and the very start of Q2. They are systematically turning their high stock price into cash, and then quickly turning that cash into high-yielding convenience properties. It's quite a flywheel. Let's look at Section 4, Operational Health and Leasing. Because, buying properties is one thing, but running them well is another beast entirely. And this brilliantly illustrates their operational strength, 4.8%. This is their same property net operating income growth. Now, this metric is absolutely crucial because it completely filters out the noise of all those flashy new acquisitions we just talked about. It tells us that on the properties they already owned a year ago, profits are up 4.8%. This proves they aren't just buying their way to growth. The underlying fundamentals of their existing portfolio are highly profitable and organically expanding on their own. The utilization metrics back this up too, but with a pretty interesting quirk. As you can see, the portfolio is 96.3% leased, but it's only 94.1% occupied. That 220 basis point gap is what the real estate industry calls a signed not open spread. Basically, it means tenants have signed the leases, but they just haven't actually moved in and started paying rent yet. For Curbline, this spread is essentially a built-in, guaranteed future boost of $8.1 million in annualized base rent, just waiting in the wings to come online in the next few quarters. And guys, when those new tenants sign, they are paying an absolute premium. Q1 new leasing spreads hit a staggering 55.9% on a straight-line basis. What does that mean? It means when an old tenant leaves and a new tenant takes their exact space, Curbline is commanding nearly 56% more in rent over the life of the lease. That is just a jaw-dropping level of pricing power. Honestly, it's not a bad deal for being the landlord of the most visible spot in town, right? It just reflects exactly how desirable these high-income, highly trafficked locations really are. Which leads us to our final part, Section 5, the bull versus bear case. Now, given all these basically flawless metrics, you might expect universal market euphoria, but actually, the reaction is intensely divided. We've got a classic Wall Street tug-of-war going on here. The bulls look at the business itself, that 4.8% organic growth, near total leasing, a massive net cash position, and an $850 million pipeline. To them, it's a flawless execution of a totally unique strategy. But the bears look at the valuation. They see a trailing price-to-earnings ratio of over 97 and an adjusted FFO multiple of 29.3x. Simply put, this stock trades at a massive 52% premium compared to the average shopping center REIT. The bears argue, quite fairly, that the stock is priced for absolute perfection, leaving exactly zero room for any economic speed bumps. Yet, despite those sky-high valuation multiples, the professional analyst community remains overwhelmingly in the bull camp right now. Looking at the consensus ratings, 88% of analysts rate Curbline as either a buy or a strong buy. And crucially, look at this. There is not a single sell rating on the board. Wall Street seems to firmly believe that Curbline's sheer first-mover advantage in this lucrative niche completely justifies the premium price tag. Which leaves us with the ultimate question for you to ponder today. Is Curbline's virtual monopoly on the public convenience real estate sector really worth paying a 52% premium over its peers? The operational data is undeniably exceptional, there's no arguing that. But as any seasoned investor knows, value is always a matter of price paid versus growth received. Thank you so much for joining me for this explainer. I really hope this structured breakdown has equipped you to dig deeper into the numbers yourself. Until next time, keep learning and stay focused.